Good afternoon, everyone. Welcome to today's webinar, summarising BDO's analysis of the federal budget, which was handed down by Treasurer Josh Frydenberg last night. Hopefully today we'll get to talk about the budget, the tax measures in it, and what that might mean for you, your business, and your organisation. My name's Mark Molesworth. I'm a tax partner with BDO. I live in Brisbane, but we're broadcasting today to everybody wherever you may be. Thank you for taking the time to join us online. I hope that you enjoy the webinar almost as much as I enjoyed watching and analysing the budget last night. Just a couple of housekeeping things with this webinar. We're more than happy to take questions on anything you hear in the webinar or anything that you heard during the presentation of the budget last night. You can ask questions by typing them into the questions box on the right-hand side of your screen. We've allocated an hour for this session, so I'm going to speak for probably 20 minutes to half an hour, and then we'll try and get through as many of your questions as are possible. We've received a number of questions in advance, which are all sitting on my screen in front of me, so we'll deal with those, but we'll also deal with questions that are entered into the questions box during the webinar, in the course of the webinar. And hopefully we'll have you on your way in about 57 minutes from now. So thank you very much for your attention, and we'll begin. This year's federal budget is obviously needs to be contextualised as part of a political process. Budgets are always inherently political, but this one is more so than ever because of the looming federal election. It's likely, as we're all probably aware from watching the news reports, that this budget won't actually be legislated, or at least the vast majority of it won't be legislated before the election is called and Parliament rises. So this budget, and indeed the opposition's budget in reply speech, which will be delivered on Thursday night, tomorrow night, are interesting because they are positioning the major parties for the coming election battle. Having a look at some of the headlines out of this budget, I think Treasurer Frydenberg's first line was that Australia was coming back into the black. That's on the basis of forecast surpluses for each of the next 4 years, which over the forward estimates period, starting with a $7.1 billion surplus projected for the year 2020, and then in total over those 4 years, total surpluses of about $40 billion, just a bit over $40 billion over the 4 years. So there are definitely surpluses being projected into the forecasts. In respect of the year ended 30 June 2019, there is a projected deficit of about $4 billion. So there was some commentary that Australia might be returning to surplus for the current year as opposed to the 2020 year, but that didn't end up happening. There's about a $4 billion deficit in the current year. The forecasts are obviously built around certain assumptions, and it's always interesting. I'm not an economist, I'm a tax professional, but one of the things that we always do when we're giving tax advice is challenge assumptions. And so it's always interesting to me to look at the assumptions on which the budget projections for the forward estimates period are based. What that shows is that the Treasury's modelling shows the economy continuing to grow at a slightly increased rate on what it is now. Primarily, I would think, or based on their projections, based on the sale of natural resources, and so playing to Australia's traditional strengths. The other thing which I found interesting in the assumptions that underlie the budget projections is that wages growth in the economy is expected by Treasury to pick up. Indeed, from its current very low rate of just over 1% a year, Treasury expects it to pick up to more like a long-term trend of 3 and a bit % growth year on year in wages. And interestingly enough, what I found even more interesting was that the year-on-year wages growth each year out over the 4-year forward estimates period is actually greater than the expected increase in real GDP. So the expected increase in the size of the Australian economy is going to be outstripped by, in terms of Treasury's forecasts, is forecast to be outstripped by the rate of growth in wages. Now, generally, I would have thought that that is not a long-term sustainable position, but obviously the economists in Treasury feel that because we have had such low wages growth over the last few years, there is a pickup to be expected in excess of the rate of increase in the size of the economy. Whether that comes true or not will be critical to the budget forecasts, because Australia still collects some 60% of its overall tax revenue from income tax on individuals, so effectively income tax on wages. So this is a key assumption that it will be very interesting to see whether it comes true. I said at the beginning that this was very much a political budget, and it's very much not about the tax measures in this budget. There are tax measures in this budget, and some of them are quite interesting for what they show about the government's priorities. But this is more about a spending budget, a budget where extra money is being allocated over the long run averages to particular areas that this government sees as important. And it must be said that this government sees as funding to support the ongoing strength of the Australian economy. So, for example, there are significant amounts of money being spent in this budget in relation to infrastructure. I mean, some of the big ticket numbers are that there's $100 billion being committed to infrastructure spending over the next 10 years. So one always needs to be careful with these budgets over which period people are talking when they're talking about large numbers like that. But $100 billion over the next 10 years, admittedly, a lot of it further out than the 4-year forecast period. But on things like fast rail corridors, urban congestion funds to try and solve congestion in the major cities. Some significant commitment of funds to natural disaster relief, also several $1 billion there, including some tax measures. So a couple of relatively minor tax measures, but important to those who are receiving them. Grants that for natural disaster relief payments that are received by residents of North Queensland, for example, after the recent weather emergencies up there, will be tax-free. Further, there are some further tax concessions for primary producers who might be forced to sell their livestock because of natural disasters. There are some tax benefits available to primary producers in those circumstances. So there's a lot of money being spent on natural disaster relief. Again, large amounts of money being spent, some $500 million being spent on vocational and further education programs. The Medicare schedule fees for GP visits becomes indexed again from the 1st of January, so a change to the position that was adopted many years ago now, where the Medicare schedule fee stopped being indexed, stopped increasing year on year. Increased numbers of medication going onto the Pharmaceutical Benefits Scheme, the PBS, again to provide more support to those of our citizens who need help with medication and the cost of medication, and large amounts of money designed to be spent on health and hospital programs, both in the capital expenditure budget to build more mental health centres, for example, but also in the recurrent expenditure budget just to fund more hospital places. Some of the things that no money was spent on, that there was some thought that there might be more commitments of funds. There is not a significant increase in the commitment of funds to the National Disability Insurance Scheme. There is a commitment from the government that the NDIS is and remains fully funded, but there's no commitment of additional funds or rolling over of funds that were expected to be spent on the NDIS but that haven't been, no rolling over of those funds into future years to increase the level of benefit under the NDIS. Although I do note that the some of the scheduled rates for the provision of therapy services under the NDIS were recently increased fairly substantially. There was some thought that there would be either an increase to the New Start allowance, effectively the unemployment benefit, or a re-indexation, a restarting of indexation of the New Start allowance, but there was no money in the budget for that either. So whilst the expenditure measures were widespread and there was a large amount of money pushed around the economy, there were still some areas that were not funded, where it was expected that there might be some increase in funding. Of course, the big ticket item in this budget from a tax point of view was the personal tax cuts regime. Now, this begins to get quite complex as to what's happening over the future years out to 2025. But in essence, what is happening is that what the government refers to as low and middle income earners, so predominantly those earning between about $40,000 and about $90,000, but extending all the way up to $126,000 in taxable income each year, those low and middle income earners receive an immediate in the sense of when they lodge their 30 June 2019 tax return and future years, an immediate tax benefit of about $1,000 a year for those who are on the maximum level of benefit from that low and middle income tax offset. In addition, there is a stated intention to, over time, rationalise the number of tax rate or tax bands in the Australian economy. At the moment, there are depending on how you count, 4 or 5 tax bands. There's a tax-free threshold, a 19% tax band, a 32.5% tax band, a 37% tax band, and a 45% tax band. All of those ignore the Medicare levy. So what is going to happen over time is that some of the thresholds for the application of those tax bands will rise. So for example, if you look at the 2023 and 2024 year column on that table, you'll see that the separator between the 19% tax band and the 32.5% tax band will increase from $37,000 to $45,000, and the separator between the 32.5% tax band and the 37% tax band will increase from $90,000 to $120,000. And then subsequently, if we go all the way out to the 2025 year, we end up with only 3 tax bands. So in essence, the 37% and the 32.5% tax bands are collapsed into a single 30% tax band. And then that 30% tax band extends all the way from taxable income levels of $45,000 all the way up to $200,000. And then the 45% top marginal rate only kicks in above $200,000. So in addition to the changes to the low and middle income tax offset and the low income tax offset, which are on the last 2 rows of the table on the screen, there are also significant reductions in personal income tax from changing those tax bands. Now, this has been put forward under the under a plan to simplify the tax bands to provide tax relief to low and middle income earners. Of course, 2025, which is when the vast majority of the tax benefit kicks in, is at least 2 elections away, possibly even 3. So at the moment, I'm behaving like the realist, some would say cynic, that I am, and not exactly betting my house that that is what the tax bands will look like in 2025. There is just too much political water to flow under the bridge between here and there. However, this is the government's plan to put money into the pockets of individuals. In terms of other personal tax measures in the budget, there was very little. There were some tweaks to the superannuation system to allow individuals aged 65 or 66 to make further contributions to their superannuation without having to meet what's called the work test. So without having to meet the requirement to work at least 40 hours in a 30-day period at some point during the year in order to be eligible to make certain superannuation contributions. There are a couple of little tweaks like that, but there were no other really significant personal tax measures in this year's budget. If we look at the small business tax measures in this year's budget, there was an announced extension to the instant asset write-off. Now, this write-off has been in place for a few years now. As it was originally drafted, it allowed businesses turning over up to $10 million to immediately deduct the capital cost of buying an asset that they used in their business up to a cap of $20,000 per asset. Now, this measure was currently legislated to sunset at 30 June 2019. In this budget, the proposal is to extend the instant asset write-off to 30 June 2020 to increase the turnover threshold up to which a business is eligible for it from $10 million to $50 million. So we're bringing a large number more taxpayers into the instant asset write-off system, and also to increase the maximum value of the asset, which is able to be immediately deducted, to $30,000. So if you consider that, or if businesses believe that this measure will be enacted, and we may need to wait until after Thursday night, of course, to see whether both sides of politics are in support of this measure, then it allows businesses who otherwise wouldn't be eligible because their turnover was too high, or businesses who were looking to buy, I don't know, new vehicles that cost more than $20,000, but perhaps less than $30,000, more access to this instant asset write-off. The other small business measures are, to be perfectly honest, fairly small and really only of interest to a very small part of the population. There is a proposal in this budget which has already been put into place in large part, but there was a small extension to it, to provide extra funding to the tax office and to the tax ombudsman to support small businesses who are having a fight with the tax office, who are in a dispute with the tax office. So if you are a small business, and in this case, small business is a turnover of less than $10 million, if you do find yourself in dispute with the tax office, there is some funding available to help you with that dispute. I've got to say it's not a lot. At best, what it amounts to is a couple of hours of free legal advice, and then a commitment by the tax office that if they engage legal counsel, if they engage a barrister to run the fight with you on their side, they will also pay for you to engage a barrister on your side. But in the absence of that, really what it boils down to is a couple of hours of free legal advice. Now, for simple disputes, that's probably a good thing. For more complex disputes, it's just simply not going to be enough to allow small businesses to take up the fight against the tax office, which inevitably has much deeper pockets than small business and often is far more committed to the cause. The final point in relation to small businesses, which really applies to all private companies, not just small businesses, but small businesses seem to be the ones who are most affected by these provisions, is the provisions of Division 7A, which deal with where private companies lend money to their shareholders or associates of their shareholders. And Division 7A is an anti-avoidance provision that in those circumstances can deem that lending of money to be a dividend. Division 7A is a terribly complex set of provisions which over the years have had band-aids applied to them time after time. There is a proposal to simplify Division 7A. The government was consulting on it, had announced that they wanted to introduce that simplification from the 1st of July 2019. The government, I think, has now realised that they've run out of time, and the proposals are being sent for further consultation and are likely to apply from the 1st of July 2020. I say there that these provisions have been deferred again because this has been one of those recurring dreams, or perhaps recurring nightmares, in every budget over the last 4 years. We've been told that Division 7A is going to be simplified and modernised and changed, and every year we get to close to the 1st of July and the budget defers the implementation date of the measures. So I think this is about our 4th deferral. Eventually it will happen. Where there are some fairly significant tax measures in this budget is not about changes to the tax law. We've really spoken about most of the significant changes to the tax law already, which gives you some indication that there's not much. The main tax measures in this budget are really about anti-avoidance, particularly if you're looking at it through the lens of how many dollars we're talking about. So the tax office is really on the receiving end of a lot more funding in this budget. They receive more than $1 billion, over $1 billion just for the tax avoidance task force alone, and then other lumps of multi-millions of dollars for other matters. And the reason that the tax office is being given this extra money is that it has proved, and the government is finding, that where the tax office is provided with money to attack tax avoidance, the returns are really good. The return is expected to be, in this budget, about $3 for every dollar that's invested in the tax office. So in return for paying the tax office $1 billion over 4 years, the expected return is somewhere in the order of $3.4 billion of additional revenue collected. There is also additional money being given to the tax office to allow it to pursue more aggressively debt collection activities for already outstanding debts. So this is not about finding more people who've done the wrong thing in the past. This is about enforcing the debts that the tax office already know exist. And there's an interesting footnote to this announcement that those debt collection activities are designed predominantly to go after high net wealth individuals and large business, and not specifically said to be not to go after small business debts. So I think the tax offices and the government are learning from certain Four Corners programs that there are certain people who get sympathy in the community and certain people who don't. The other interesting point is that there is a reasonably large amount of money in the multi tens of millions of dollars being provided to the tax office in the capital expenditures budget for further data analysis capability. So this means that the tax office already knows a lot. They have a lot of data about taxpayers. The question is, can they do enough with it? This budget is giving them the tools in order to analyze that data, cross-match it, and get to a point where perhaps they know more about taxpayers than the taxpayer knows themselves. The final measure on this slide is about Australian business number compliance. And what this provision will do from the 1st of July 2021, so it's a little way in the future yet, but if enacted, this provision will require any ABN holder to lodge their tax return every year or face the loss of that Australian business number. And of course, without an Australian business number, without an active Australian business number, businesses find it very difficult to actually operate, because anyone that they are supplying services or goods to and to whom they can't supply a valid Australian business number is required to withhold 47% of any payment that is made to them. So without a valid active ABN, it's very difficult to carry on business. So the proposal is quite blunt in that if you fail to lodge your tax return, your Australian business number will be cancelled, or perhaps more correctly, inactivated. That is going to be a real incentive to make sure that people who hold an Australian business number remain up to date with their compliance. Some other measures that we need to talk about. There's been a lot of noise about the research and development tax incentive over prior years. In fact, in last year's budget, the government proposed some changes to the tax incentive that have still not passed Parliament, and to be perfectly honest, given where we are in the electoral cycle, are unlikely to pass Parliament before the election. So there's no change in the law proposed in this year's budget, but interestingly enough, there's $1.3 billion in savings from the R&D tax incentive. So in other words, the government thinks it will be paying $1.3 billion less out to claimants under the research and development tax incentive than it thought at the same time last year, under exactly the same law. So what that indicates, and it is what we are seeing on the ground, is that the regulatory authorities, AusIndustry and the Australian Tax Office together in this case, are taking a much harder line with taxpayers claiming the research and development tax incentive. Now, depending on who you are, they're taking a much harder line in ways that are appropriate, and in some cases, they're taking a much harder line in ways that advisors may say are not appropriate. But be that as it may, the government is obviously seeing some significant savings coming through from not paying as much to companies undertaking research and development. The Export Market Development Grant Scheme is being given extra funding, $60 million extra over the 4-year forward estimates period. Unfortunately, that still means it's not going to be fully funded. So the Export Market Development Grant is a federal government grant program that pays money to people who are undertaking export activities. It's supposed to refund about half of your eligible expenditure, but it has not been refunding anything like that over the recent years. $60 million over the next 4 years will be a good start, but it's not going to solve all the problems. And finally, just an interesting point, single touch payroll is going to be expanded further. So single touch payroll means that every time an employer does a pay run, they automatically transmit the data in that pay run to the tax office. So the tax office knows exactly what employees are being paid in real time. That information, which the tax office has now in respect of employers with 20 or more employees, and from the 1st of July this year is going to have in respect of all employers, no matter how many employees they have, that information is now going to be shared further, and more detailed information is going to be required to be sent to the tax office every time a pay run is done. Now, that is going to make it, first of all, even more critical that employers are using electronic payroll systems, because that makes the single touch payroll compliance simply a matter of pushing the button, because the payroll system does it for you. But it also means that the tax office is going to know a lot more about what employees are being paid. But the tax office is also going to be allowed to share that data much further. And the one example that I have for you, the tax office is going to be allowed to share that data with Centrelink in real time, so that recipients of welfare benefits no longer have to estimate their income each fortnight. Centrelink will just know, because they'll have access to the tax office data. So how would I summarize this budget? Well, in terms of tax, there's not much going on for businesses. There's nothing there to scare business. There's nothing there to make business rejoice, really, as long as those businesses are doing the right thing. If you're not doing the right thing, that extra $1 billion in funding for the tax office should have you very concerned, whether you're not doing the right thing by not complying with your tax obligations, or if you're not paying your debts to the tax office. The message here is we really need to be getting all of our houses in order, because the tax office is being funded to come and make sure that they are. One of my disappointments in this budget is there's no evidence here of tax reform. We've changed the personal tax rate system, okay? That to a certain extent simplifies the system, perhaps. To a certain extent, it reduces the tax burden on individuals, but I'm not certain that any of that really represents structural reform to the system. Nobody is talking about the mixture of taxes that are being collected. Nobody is talking about whether there are certain taxes which are a dead weight on business that really need to be phased out. There is no indication that the tax reform process in Australia is going anywhere. And if I had to summarize this budget in its entirety, it's a spend and get re-elected budget. It cannot be seen outside its context. Its political context is all here. So I'm now very happy to answer your questions. If you wish to submit questions, please type them in. We'll try and get to as many as we can. We have about just under half an hour for those questions. If we run out of questions, I'm not going to try and extend this out. I'll give you all some time back into your day. But some of the questions that came through before today, so as people were signing up for this webinar, first of all, there's one which is, what are the benefits to small business in the budget? Well, there's the instant asset write-off. The increase in that threshold, if it's legislated to $30,000, probably makes it more useful for a lot of businesses who are looking at things like motor vehicles for use in their business, or those sorts of chunky assets. The increase in the turnover threshold to $50 million from the current $10 million, again, if it's legislated, that will be valuable to those taxpayers. I think we estimated overnight there's about 22,000 of them who fall into that $10 to $50 million range. That will be useful. Otherwise, there's not much. There's not a lot of small business, other than the tax office apparently is not going to be more aggressive with respect to collecting debts from small businesses. They'll be more aggressive with high net wealth individuals and large business. There's a question about what are the likely implications for property of this budget. Again, there's not a lot to see here. There's certainly, from a tax point of view, there's no immediate impact. It will be interesting to see what the opposition's budget and reply speech says on Thursday night. I would expect, or all indications would seem to indicate, that the opposition will be committing to its policies around negative gearing and so forth, which will have an impact on the property market, I think, almost for sure. But it's almost too early to make that call, because we have a whole election process to go through before we start making any decisions about the impact of likely government policies on property. So it's a little bit of a wait and see. I've been asked a couple of questions about the status of legislation which is currently before Parliament and what's going to happen. It would seem to me that there's a large amount of legislation which is just not going to be passed before the election. So, for example, the superannuation guarantee amnesty, which was announced last May and is supposed to finish up this May, I just don't see a prospect of that passing Parliament before the election. So that bill will lapse, and then it will be a question of what the next government, whoever that might be, is going to do. There are a large number of other bills as well dealing with superannuation matters, income tax matters, and so forth, which are just not going to make it in the time that's available. And so what we will be waiting on with bated breath is to see whether either of the major parties commits to reintroducing and passing those laws once Parliament resumes after the election, or if we're going to be put into the fairly uncomfortable position where there is no announcement and we just have to wait and see. So some other questions that are coming through. So there's a question there about what the definition of turnover is in relation to small business, and is that total income as disclosed in the tax return? The definition for small business turnover drives off what in a technical tax terminology is ordinary income from the ordinary conduct of the business. So it's not necessarily the same as total income on the tax return. It could be a smaller number, slightly. But the other thing to take into account is that the definition of turnover includes turnover by connected entities. So connected entities is anyone in whom we have a 40% ownership interest, or who owns at least 40% of us, or where we're connected together through a common 40% owner. So you just need to be a little bit careful about the definition of turnover, and I'd encourage you to take advice if you're going to be close to that $50 million threshold, or indeed the $10 million threshold for some of the measures. But it's not just total income on the tax return. I've been asked how we would assess the effect on employers in this budget, particularly small business employers. There's probably not a great impact on employers. There's no changes to the proposed rate of increase in the super guarantee charge. There's no change to anything much. Single touch payroll for most employers should be automated. So whilst that is being expanded, it should just be a matter of software updates being provided. Now, whether those software updates get provided or whether employers are actually using electronic payroll systems is of course a question. And the other thing with single touch payroll, but this already exists and it's not part of the budget, is that single touch payroll gives the tax office a lot of real-time data about whether, as an employer, you're meeting your obligations to withhold and pay tax from employees' wages and to meet your superannuation obligations. So I think single touch payroll is probably the key there, but I don't think it's going to have much of an effect on businesses that are doing the right thing. I've been asked to confirm any change to the NDIS because it appears some of the surplus comes from a reduced spend because of the slow rollout. So that's true. There's about $1.6 billion, I think, that was projected to be spent over the last years, which hasn't been, and in effect, that's not being rolled forward to top up payments under the scheme. However, it is an open-ended scheme, so when the government says we're committed to fully funding it, it's fully funded out of consolidated revenue. So it's a bit of a question about how fast people are taking up their entitlements under the NDIS and how fast the National Disability Insurance Agency is rolling out disability packages to people. And a related question, I've also been asked about any movement in the rate being paid by the NDIS for services, and there is. That was announced, I think, in the last 2 weeks. There was an increase in the certainly in the rate for the provision of therapy services, and I think in the rate for the provision of in-home respite services, and both of those were increased fairly substantially, which was good news for providers under the NDIS. I've been asked a very technical question about Division 7A. So given that the Division 7A legislation has been deferred at least until the 1st of July 2020, what are my thoughts on what are technically called subtrusts maturing before up to the 30th of June 2020? My expectation in that case is that the tax office is going to release further extend its administrative treatment. So over the last couple of years, as the Division 7A changes have been pushed out, the tax office has provided an administrative approach to loans and subtrusts that are maturing over that period, and I would expect that the tax office will extend that for another 12 to 24 months as we sort out Division 7A. Does the budget include any stimulation for the provision of social or affordable housing? There were some housing funding announcements in this budget, but not stimulus of the economy for that provision as was provided in last year's budget. Sorry, I'm trying to remember back to which year it was, but I believe it was last year's budget where there were concessions provided, including an increase in the CGT discount to certain entities for building new affordable housing. So there was no big ticket item like that in the budget for this year. And then I've been asked about again, a technical question around Division 7A. The Assistant Treasurer, Stuart Robert, at a recent conference said that in relation to the position paper that the government was consulting on, that his view was different to Treasury's as to what the appropriate outcome was. I'm not quite sure what the Assistant Treasurer was trying to reference there. I suspect that there were some fairly disturbing proposals in that Division 7A consultation paper, which would have made life considerably more difficult for certain taxpayers. So I think that the consultation process obviously pointed those difficulties out to Treasury and to the government. And I think what the Assistant Treasurer was indicating there was that he had heard those comments and was likely to rethink that consultation paper and possibly even put out a new one for further consultation. So it's a bit of an unfortunate position. The Assistant Treasurer is essentially saying that, you know, we've done the consultation, we're not sure that this is the right outcome, and therefore we're going back for more consultation. In a sense, that's a good outcome, because imposing new legislation which is going to cause problems is not the best idea in the world. But it's a shame that it's taken this long for amendments to Division 7A, which, you know, in reality were first proposed to the government in 2014, have not yet been implemented and won't be implemented until at least 1st of July 2020. So that's somewhat concerning. The list of questions seems to be drying up, so I'll give anyone who wants to ask the question, a couple of minutes to do it. Oh, there we go. It's amazing what happens when you call for final questions. The question is, do I see the federal government putting pressure on, or being likely to put pressure on the states to reduce payroll tax on small businesses to reduce the tax burden? As we sit at the moment, I've got to say that I don't see that as being a likely outcome. I would certainly encourage that to be the case. Payroll tax, to me, would appear to be one of those deadweight taxes that weighs on the employment of further staff by businesses. So it would seem to me to be a sensible move to reduce or even remove payroll tax as part of a holistic tax reform process and replace it with taxes that don't have such a deadweight effect on the economy. However, having said that, I don't see our current political environment as being particularly conducive to that conversation. Who knows? After the election, maybe. Who would know? So that would seem to be it, and I would like to thank you all for taking the time to attend today's webinar. I hope you found it helpful and useful, if not interesting. We are talking about tax after all, so interesting might be a step too far. For those of you who either want to hear this webinar again or want to share it with all your friends, a recording of this webinar and a copy of the presentation will be emailed to you later this afternoon. You're more than welcome to share that with whoever you like. At the point where we end the webinar, a short survey is going to pop up on your screen. We'd really appreciate you taking no more than 2 minutes of your time just to share your feedback on this webinar. We want to make sure that these webinars are hitting the mark. We want to make sure that they're interesting to you and that they're of a high quality. So if you have any feedback for us, positive or negative, please share that with us. And finally, thank you once again for your time, and I hope you all have a great day. Thank you very much. Goodbye.